and welcome to this Diwali special on ET Now. I am Anisha Jain. Joining me today for a special conversation on this series of Wizards of Wealth is Ashish Shanker, the man from Motilal Oswal Private Wealth. Ashish, hi, great to have you in the studio today and happy Diwali.
Yeah, very happy and prosperous Diwali to you, all the people in your studio and your viewers.
Thank you so much for that. But since we're talking about wealth today, let me start with a basic question. What does wealth mean to you?
So, for me, wealth means not having to think about wealth, because if you have enough wealth that can provide for all your needs without having to bother as to where the money is going to come from. That for me is true wealth.
Okay, don't have to worry about it. But is it a golden age of creating wealth? And I ask you that because, of course, you have Warren Buffett as an example who made bulk of his wealth in his 60s, and after that, there are others who believe that you need to start really early because that is when compounding really comes into picture. There are others who say 40 is the best age because you've matured, made your mistakes, and you know exactly what works for you. Is there any concept like golden age of creating wealth?
Right. See, all of what you said is true, right? The earlier you start, you have a better shot of creating big wealth, because that's how compounding works. But in the journey of every country, there are periods which is looked back as the era of wealth creation. So, for example, if you just look back in the recent past in the US, 82 to 2000 in the US was such a period where there was a lot of wealth creation across the board. I truly believe that, see, look, last 20 years again in India, there is a lot of wealth which has got created. But I think this decade is different. This decade is going to be a decade where wealth is going to be created across the board, right? It's not a narrow part of the population which is participating. If you just look at the number of DMATs, pre-COVID we were at about 40 million DMAT accounts. Today you're at 170 million. And if I believe, if I look at the trend, and if I believe what some of the other experts say, we are probably headed to 500 million over the next decade or so. So what is different this time, Anisha, is the country is at an inflection point. The fundamentals look good. Many businesses, sectors are participating in the wealth creation journey, and you have a lot of domestic savers coming into the markets and getting value from the markets. That is really heartening to see, because in the earlier bull markets, we just had a sliver of our population participating in the wealth creation.
Let me take a step back and talk about the overall portfolio allocation and how the Indian markets are stacking up versus rest of the world. Because on one hand, of course, you have a good value which is still there when it comes to the US markets, because they are getting ready for a bit of an inflection and they have done well for the last 12 months. And then on the other hand, you have China, which makes for a great tactical play right now. So if you had to pick up, let's say, just in equities across the globe, where does India stack in your pecking order?
So look, we are big believers in diversification, global diversification, and increasingly what is happening in larger customer portfolios, the dissemination of news is digital, and everybody is very well exposed to what's happening around the globe. We believe that the best fit for somebody who's investing in India is US. And the reason for that is, US is a developed market as opposed to India, which is obviously an emerging market. The second reason is the correlation between the US equity markets and Indian equity markets is much lower than what is perceived. In statistical terms, I'll tell you it's 0.3, which basically means that when US does well, India does not do that well, and vice versa. So US gives you true diversification. So if you look at the last 3 years, right, or probably this decade, I genuinely believe that India will do better than US in this decade. And last 3 years, India has done better than the US. Of course, the last 12 months have been slightly different, but I still believe that this decade, India will probably do better than US. But having some US exposure in every portfolio gives you the much needed diversification and the cushion. And just going back to my earlier example, if you look at the last decade belonged to US.
Yes.
NASDAQ was the top performing index in the world, right? But this decade is going to be different. India is already coming out to be one of the top performers. If you look at the mid-cap indices in India, they are probably amongst the top performing indices in the world, right? And I think that trend will continue. As far as your China question is concerned, yes, there is a lot of interest in China because of valuations and some of the policy changes that the government has done. But I still believe, or this is how people are thinking about China, that it's at best a trade, because people are still not believing that fundamental changes or fundamental outlook on from the government on businesses is likely to change. Yes, China is cheap. Yes, there is some loosening of monetary policy, which is bringing money into the Chinese stock markets. But at best, people are looking at it as a trade right now.
Okay, so a tactical trade perhaps, China not an investment at this point of time, and US of course is the big one to watch out for. But within, let's say, portfolio allocation now, what about debt as an asset class given the interest rate cycle that is turning right now, and gold, which is of course run up what 30% already this year, and I don't know, if you go by some of the technical experts, they're expecting 20-25% more.
In fact, we were amongst the few people last year who were very bullish on gold.
Okay.
Right, and there were multiple reasons for us to be bullish on gold, and that's the one asset class which has kept pace with equities in India. So that's why this Diwali there is a little more glitter, right? But we believe that the next few years again, gold is in a good place. Gold should do well for 2-3 reasons. One, interest rates globally are coming off. Second, in spite of all the good news, right, there are a lot of geopolitical tensions lurking around the corner, right? So we look at gold not just as an allocation, but we look at gold as an insurance to your overall portfolio. So if something goes wrong globally, temporarily, right, and if equities do pull back, gold is that asset class which protects your portfolio and gives you the much needed firepower to reallocate. So beginning of the year, we said this is the year of the all-rounder. What does that mean? We believe that all asset classes have a place in the portfolio, whether it's equity, whether it's debt, whether it's gold. And it's a great period because after a long time, I'm seeing all asset classes performing.
What's the reason of that? Because it's very counterintuitive. Usually when one thing does well, the other would not. Because if you're going for safe haven, let's say gold, your equities should ideally underperform. Does it happen often in cycles?
No, there are short periods where it happens. And I think it's a confluence of factors. Indian equities are going up because of domestic reasons, as we discussed. Gold is doing well because of global reasons.
Yeah.
And debt, again, is doing reasonably well because interest rates are becoming softer in India. I think this trend will persist going forward. So if you're a balanced investor, let me give you an example of a balanced investor.
Sure.
Typically, a balanced investor will probably have 50% in equities, right? Of which I think 10-15% could be in global equities like US mainly, right? About 10-15% can be in gold and rest in different types of debt products. So that's a classic balanced portfolio. I feel that, given where we are entering, from a market point of view this Samvat, I think from this Samvat to the next Samvat, I think you should be neutral weighted. You should have all these asset classes. There is no reason for you to go overweight or underweight in any asset class.
Okay. But coming back to the mainstay of the asset class, which is the Indian equity markets, of course, you have said that it is better to have realistic expectation for this year because there is expectation that we'll see a time-wise correction. Within that, which are the pockets that you would recommend an overweight on? Are those the sectors which haven't done anything and there's just going to be a churn, or just stay with the momentum?
So I think there are certain sectors where we've seen some correction, and namely you have the PSU pack, you have the cap goods, engineering, defense sectors. I think they had run a little faster than the other sectors, and mind you, these are sectors which are asset heavy sectors, right? So there is a limit on the kind of operating leverage that they can produce, as opposed to maybe a digital platform where the operating leverage can be very, very exponential, right? So I think these sectors are likely to underperform for a while because of sheer valuations. I mean, the business may do well, but the business growth and stock prices may not necessarily coincide at certain points in time. I think a lot of the growth is priced in. But there are a lot of other sectors where we are witnessing a new lease of growth, and valuations are also reasonable. So sectors which are global facing, let's say for example an IT, for example a pharma, these sectors are seeing a new lease of life. I mean, these have been reasonably subdued. And I think digital companies which are digitally oriented, the bull run continues for them. I also believe capital market as a sector, because most people are seeing channelizing savings from the traditional bank deposits to capital market kind of investments. So I think all the companies which are at this inflection zone, who are actually channelizing these savings into capital market instruments, all these companies are doing extremely well. So I think these are few of the sectors I would continue to remain invested or continue to invest in. And I think one sector, in the infra space, which will continue to do well, according to me, is real estate.
Are there any couple of mantras or rule book that you have managed to create that you really stick by?
I think the foundation of creating any portfolio is asset allocation, Anisha. You need to first figure out how much risk you can take. And when I say how much risk you can take, it's not today, because today everything is great and people are extremely optimistic, right? What your risk profile was when the markets went down 30-40% is really your true risk profile. So do not forget that. So I think asset allocation is the fundamental principle of creating any portfolios.
Leave our viewers with what you think is going to be the best wealth creator for Samvat 2081.
So I would continue to bet on two sectors. One is, companies which have a very strong digital backbone, right? Because there the operating leverage is extremely high. There are companies which have built out the entire digital infrastructure, and now it's all about execution, right? So every incremental rupee of revenue you generate,
the
cost
line
doesn't go up as much. So I think digital sectors will become extremely large in India. I think the two other sectors I would bet on, one is capital markets, and third is, like I said, the real estate sector.
Thank you so much for making time and speaking with us today and talking to us about these whole host of topics, right from India, China, US to other asset classes. Really appreciate you being here.
Thank you, Anisha, for having me on your show.
With that, it's a wrap on this conversation. Stay tuned to ET Now for more.
If you like this video, then like, share and subscribe to ET Now.